So in about a minute, we'll get started with the session, but I'll give a brief intro. I'm Zohaib. I basically do a lot of the marketing stuff here at Muslim Professionals. You probably got newsletters from me, spamming you guys on a weekly basis about random topics and thoughts that are in my head, and things that we see in the group, and upcoming events. We have Sharaz and Demir from Cetera Investments. And if you guys want to start letting us know, what is Cetera and what you guys do there?
Yeah, so when it comes to Cetera, was going to go over it during our initial introduction. So Cetera is an independent broker-dealer that Sharaz and I work with. They are nationwide and also one of the largest independent broker-dealers in the nation. And harping on the independent side, like what does that really mean? We get that question a lot. That means that Cetera doesn't manufacture any products. So we're able to give full non-biased investment management advice to all of our clients, right? So we don't pick or choose one company over the other. We choose the right products that specifically are tailored for our clients' needs and wants.
Yeah, I mean the big idea behind being independent, right, is we're not held to use one company, right? We can literally use whatever we want in the industry, and some cool stuff gets to happen, right? Two situations have came up pretty recently, with respect to the Muslim community. I had a client; she's been with one big firm for a very, very long time, very wealthy individual. And she's like, yeah, I went to my guy and I was like, hey, I want something that's, faith compliant with the Islamic faith and the Sharia. And he's like, I don't know what that is. And, I don't even know if we have any mutual funds or investments that can hit that requirement. Right. And she was like, okay, so let's explore what I'm invested in. Right. And went down to dive into her funds and what the funds actually hold. And she's like, well, I don't want to invest in these companies for whatever reason. And he's like, well, you can't dictate that, right? You can choose the fund, but you can't choose the investments in the fund, right? And she's like, you know what? Just put all my money in cash. I don't want to deal with this. And she took about, almost a year to find someone that can help her out. I got to say, she actually, you remember the WhatsApp group that we used to have? Right. She actually found us through the WhatsApp group. Right. And, we've been speaking back and forth for about 6 months. And, I sat down with her and we have these specific accounts that are created where they're individually managed accounts, right? Where you actually own the underlying stocks. So you can get very, very selective on what you want and how you want to own it and when you want to own it. So we virtually eliminate all restrictions. Now we get to work with some big firms to create this stuff for us, right? This one was created by Russell Investments for us. It is their Sharia screener, so it hits all the compliance guidelines, and returns are phenomenal. It was launched maybe about 3 or 4 months ago. Returns are pretty great. It's been a very interesting period of time since this has gone live.
Beautiful. Beautiful. Well, it looks like we're getting a lot more people in the room now. I wanted to ask you guys, what are we going to be talking about today? And yeah, what should people expect?
We're going to be talking about the year-end financial checklist. So seeing that we're only, I guess, less than 6 weeks away from 2025, it's really important to start tackling and making sure that we've hit and checked off all our boxes to make sure that we get a head start on 2025. Whether it's going over tax situations, whether it's going over maximizing your contributions towards retirement accounts, or even children's accounts like 529 plans, we're going to cover on a number of topics that will be specifically tailored to everyone's questions.
Amazing. All right. Well, without further ado, I'll give, I guess, Sharaz, you're going to be sharing your slides, correct?
Yeah, I'll be sharing the slides. Demir will be managing the chat. We're going to try to go for 25 minutes or so, and then have plenty of time for question and answers for everyone. So, we're here for the community. And so we're willing to spend as much time as, we need to answer those questions, make sure everyone's kind of understand what's going on.
Beautiful. Well, I'm going to go backstage and I'll let you take the helms from here.
All right, great. Again, assalamu alaikum, everybody. Hope everyone's doing well. Again, my name is Sharaz Khan. I'm a certified financial planner with Cetera Investors. My partner, Damir Nikovic, is on as well. We work together in our team. So just want to take a step back. Cetera is a very large independent firm. Damir and I are here in New York, but we have clients in well over 20 states. So we can really cover anyone, around the country. Cetera has offices and locations nationwide, so we can take care of folks. Tonight, we're really going to talk about your year-end financial planning checklist, and you want to use this time to think about it as a call to action. We're going to be going through what you should be thinking about, and it's just some things that have probably slipped your mind over the course of the year. Folks get busy with work and family and all that other great stuff. So I'm going to share my screen. We'll jump through some slides here and have plenty of time for Q&A. So hope everyone can see the screen. Damir, give me a thumbs up if you can see it. All right.
Okay.
Great. So we're going to start again, the year-end financial planning checklist. A little bit more about Cetera. Again, we look to maximize our clients' wealth and have a personalized approach. Again, here's our contact information. We'll make sure everyone gets it, at some point tonight, and the team will send it out as well. So first thing we like to talk about is, when I was speaking to the admin team, they asked, how do we really choose an advisor, and what are things that you should be thinking about, right? And what are the stigmas that you shouldn't worry about? So I tell folks, you really want to think of three things when you're choosing an advisor. The first thing you want to think about, is the person's qualifications. Make sure that person is truly a financial advisor. That person is a fiduciary. Ideally, you want to work with someone that's at an independent firm because they can really customize portfolios to suit your needs and not really suit you to the portfolio, right? And the third thing, again, make sure that person is a fiduciary, preferably a CFP, just because we've developed the expertise in this space. So first thing I want to talk about is the financial planning process. This is what we take all of our clients through. The first thing we like to do is establish clients' goals and their values and see what's really important to them. During that process, during that first consultation, while establishing those goals, we'll go through and gather all their financial information. Kind of like run down the family tree, run down the asset list, run down, the income schedules and, whatever businesses they may own or any big life-changing events. We then take that info, we analyze it, we create a financial plan. Then we go meet with our potential clients again and present the plan, right? Present investment options and alternatives. Right. And we let our clients think about it. We tell them, hey, this is going to be a big decision. You're going to be working with us for a considerable amount of time, for 10, 15, 20 years. So we want to make sure that, you're comfortable with the relationship and comfortable with the recommendations. And then finally, when our clients are ready to go ahead, we just implement the strategies, right, through various processes. And then the most important thing is our review process. We found most advisors will get you set up and then kind of leave you alone for a year and then wait for you to call them. Damir and I and our team is extremely proactive. We run, monthly webinars for education purposes based on whatever's going on in the market space. We just had a pretty big event a few weeks ago, which was prior to the election. We had a ton of people on that one. And we look to review with our clients at least twice a year, do formal reviews. But again, we like to stay in touch and reach out to people every couple of months or so just to make sure everything's going well. So the first thing you want to think about when you're thinking about your year-end checklist, you want to remember and see what life changes you had. Did you recently move? Did you start a new job? Did you get married or divorced? Did you just have a child? Or are you receiving a gift or getting a big inheritance? Right? These life changes can significantly impact your tax return and investment situation by the end of 2024. Right? You may have moved from one state to another. say you move from New York to Texas or something like that. You're all gung-ho on the tax-free status of, no state income tax in Texas, but you lived in New York for 8 months out of the year, right? Unfortunately, you have to wait another year before you get those tax exempts, right? For folks that have recently got married, I tell them all the time, you should reach out to your accountant now before tax time gets crazy and say, hey, I just got married. My spouse makes X amount of dollars. Should we file single for 2024 or should we file married for 2024? And let them do an analysis, right? Don't wait until, you get to tax filing time. Same thing with if you just had a divorce. The big thing is, alimony and child support are no longer write-offs, right? So if you're, in that situation, those are things that you want to speak to your accountant about because you're going to be paying out some cash and you're not necessarily going to get a deduction. Next one is taxes. Taxes is extremely important for the end of the year. The markets have been very, very nice in 2023 and 2024, but you would want to speak to your tax preparer and say, hey, do I have any carryover losses that I can use to offset some of these gains that I have in my account? Right? You also want to forecast what 2024's income will be and potentially what 2025's income will be. This is specific to our executives who are looking at getting bonuses or our business owners that can really control when they report income. You may want to say, hey, I have enough income for 2024. Maybe I want to push some of that off to 2025. Or you may say, hey, I'm planning an expansion in 2025, but it may make sense to buy the equipment in 2024 to take advantage of, like a 179 deduction or something like that, right? You also want to look at the new tax act. A lot of this will be state dependent, right? We're not seeing a ton changing at the federal level at this point. But, I tell folks, if you just bought an EV or if you just put solar on your house, you want to look into how those discounts will reduce your overall tax burden, right? That's where we get into the potential donations and the credits. And the last thing, I know most people on this live stream tonight is part of the Muslims professional community, and we tend to give zakat every year. A lot of those donations, just remember, those are taxable write-offs, right? So we want to make sure that you're really getting the best out. Next thing we're talking about is retirement. I feel like this is always on folks' mind, but we're looking at retirement from a different aspect right now. We're talking about what's going on with your retirement accounts. You want to look at those 401ks, those 403bs, and make sure, if possible, you're maxing out the contributions, right? Now, the thing to remember is you can only put money in there through payroll. So we got 6 weeks left in the year, so you may want to increase payroll contributions a little bit. Also want to look into those traditional and Roth IRAs, right? The Roth IRA is one of the greatest retirement tools in the industry because of the preferential tax treatment at distribution. Now, I know most of the folks on the call are a bit young, but we do like to talk about RMDs. RMDs are those required minimum distributions. Typically, folks only think about it when they get to age 73 and the IRS requires you to take money out of your retirement plans. But, if unfortunately you had a parent or a loved one that passed away and left you their retirement accounts, you became the beneficiary of it, you're expected by the IRS to take those minimum distributions. And then, if you don't take them, there's a 50% penalty on that. So those are all things you want to consider. For my business owners out there, we want to, think about those self-employed retirement plans, the SEPs, the Simples, the solo 401ks. Guys, I tell all my business owners, right? You're either going to pay the tax to the IRS or you're going to save it for yourself for later. Most people are always going to be on the side of wanting to save it for themselves later. So, you can reach out to us or reach out to your tax preparer and say, hey, I'm having a pretty good year. I don't have a traditional 401k plan or something like that. Does a SEP or a Simple make sense? And if so, how much can I put in there, right? We'll talk about that. And the last thing for retirement is you want to roll over those old employer plans, right? We've had a lot of folks change jobs over the past few years. And what we find is that people tend to leave their old 401ks at their old employers. We preach pretty specifically, take your money with you, right? So if you're changing jobs, we want to keep that money with you. I like to use a simple analogy, right? Let's say you're renting an apartment and you decide to move. Would you leave your valuables in that old apartment? And the answer is no, right? So don't leave your 401k at your old employer, right? Along with that, for our executives that are in the audience, a lot of people get stock in their 401k, right? You may not want to sell that stock, but you definitely want to move the 401k. So you want to look into, the NUA type features that are built into these plans. If you don't understand what NUA is, feel free to reach out and we'll happy, walk you through it. And those folks that, again, on the executive side, those folks that are receiving stock options, you want to remember when you start exercising these options, these things can trigger the alternative minimum tax. So you want to be conscious of that, right? You want to be conscious of any capital gains that are going to come off of there that are going to switch from, short term to long term, right? You're going to want to be conscious of, if you're a higher earner, are you subjected to the net investment income tax, right? If this is the first time you're hearing about this and you have questions, by all means, reach out. We're here to help. We'll talk about some retirement milestones. Again, we have a pretty robust audience, right? So big milestones is at age 50, you can now make excess contributions into those retirement plans. At age 59, you can take out with any penalties. Between 62 and 70, that's when Social Security is going to happen. You got to make a decision at that point. At age 65, that's our Medicare time frame. And at age 73, that's when those RMD starts. If you're someone that recently turned or is looking or is expecting to turn 65 sometime soon, and you're going through the Medicare process, it is a very daunting process, right? There's a lot of moving parts with, these advantage plans and supplemental plans, and they become very confusing. We don't sell any of those plans, but we have professionals that we recommend, right? So feel free to reach out and, we'll be happy to discuss that with you. Whenever I talk about retirement, folks always ask, how much do I need to retire? That's the big question. So we like to back into the numbers. So what this slide shows is if you're making 50 grand today and you're thinking about retiring, 20 or 35 years from now, you want to think about what the actual dollar value of that 50 grand will be. So if you're making 50,000 at 4% inflation, you're thinking about retiring in 20 years, your retirement accounts are going to have to generate you $110,000 in income, right? And then we work backwards to build that number. Now, just keep in mind, as you earn more money, right, year over year, right, these numbers have to get bigger. We haven't met any client that said, hey, I want to earn less in retirement. It goes against human behavior. Humans like to maintain their lifestyle and actually increase their lifestyle year over year. So you want to keep conscious of that. We'll get into investments. You want to really review all of the investments that you have now. Make sure the strategy that you set up is hitting those goals. If they're not, something's broken, you got to fix it, right? You want to look at your income and your savings needs. If you just got a raise, are you saving the same amount of money? Are you actually able to save more, right? Do that budget, figure out where your expenses are. You want to look at your asset allocation. If you invested early in 2024 and, you had a blended asset allocation, there's a very good chance the numbers have, gone off, right? The markets have performed very, very well. So you want to look and see, hey, is there an opportunity for me to do a little bit of rebalancing to capture some of the gains that I just had? Now, with that being said, not all investments go up at the same time. We preach a lot about tax loss harvesting around this time of the year. Right? So you want to make sure you look at your assets and say, hey, this company didn't perform very well. We'll look at the tax lots that you own. And if anything is negative, you want to sell your losers, right? Realize those tax losses to offset these gains. And, when we get to dividends and distributions, we want to make sure that the dividends that you're receiving could be as qualified as possible or as tax exempt as possible. The idea behind investing is to make a bunch of money, right? That's what it really comes down to. But it's not only to make a bunch of cash. You want to make sure that you share as least as possible with the IRS. And that's what these strategies help you do. If you're investing pretty heavily and you haven't had that conversation with an advisor to see how much of your gains you get to keep, right? Then, I highly recommend having that conversation. Folks always ask us, how should we structure our investments? Now, I know the topics that I'm discussing are at a very high level and everything we can dive into deeper. But again, we wanted to use tonight as kind of like a call to action to get you thinking about what you should be doing. So when you're structuring investments, you want to think of it with respect to time till use. Everyone throws around this word called time horizon. So things that you're looking to use within the next 6, 12 months, you may want them to be really, really conservative, really, really liquid, potentially money markets, maybe some CDs. If you're trying to avoid Riba, there's definitely other accounts that you can have that don't have that interest payment. When we start to go down the line, right, and we're thinking about, hey, I want to have some money put aside for a down payment that I'm looking to make on a property 5 or 6 years away, that money could be a little bit more moderate. You could take a little bit more risk with it because we have, 5 or 6 years until we're looking to use it. For money that you're like, hey, I don't plan on touching for 10, 20, 25 years, that's where you want your really, really aggressive investments at. And this pertains to any type of investment, whether it's property, crypto, stocks, bonds, any of that stuff, right? You always want to allocate it with that whole time horizon or time till use. Next one's up is insurance. Life changes a lot, right? This time of year, it's a lot of open enrollment going on in the health insurance space. Plan changes every year. Plan premiums tend to go up every year, especially if you just got married or you just had a child. You want to anticipate those extra costs that are going to come. The other thing is, we get into property casualty insurance. That's, cars and liability insurance like that. And we live in the state of New York. New York just increased their rates by 24%. So regardless of what car insurance provider you have, regardless of how good your driving record is, you just got a premium increase. So we want to anticipate those types of things. We find that a lot of people are underfunded on their liability protection. Now, again, we don't sell any property or casualty insurance. As a good advisor, we try to make sure our clients are protected from any type of financial harm. So we want to make sure that, you have adequate coverage. Last thing is the beneficiary changes. We go back to those life events, right? You just had a child, you just got married, or you just got divorced, right? Or, something happens and someone that was your beneficiary should no longer be your beneficiary. You always want to make sure that you're updating this. We cannot count the times where we meet with clients to review their beneficiaries. And these were things that they set up 10 or 15 years ago. And when we tell them, hey, this is the listed beneficiary, they go crazy. They're like, no way, I don't want that person to get any of my wealth, right? I want it to go to my kids, or I want to go to my parents, right? Or my brother or sister, whatever the case may be. You just want an audit of it, make sure it's up to date. Coming to the end here, we're talking about estate and legacy planning. We want to start looking at creating those wills and those trusts and those other legal documents like healthcare proxies and power of attorneys. I like to tell folks, especially young families, there are 4 essential documents. There's the living will, the final will and testament, the healthcare proxy, and the power of attorney. But also, you want to get that standby guardianship, right? If you have children, do not assume the state will do what you want them to do if it's not in writing, right? We actually had a pretty interesting case where a grandparent passed away here in New York and left his grandson as a beneficiary. His grandson is 7 years old, right? The account has to be a custodial account. The state told the mom, she's not the custodian until she petitions the court to get a custodial agreement, right? So every state is a bit different. You want to make sure that these documents are done and these documents are accurate, just so we don't have to worry about anything going wrong in the event that someone gets hurt or gets ill or passes away. We get into charitable contributions. Again, charitable contributions are tax deductible. If we're going to give zakat, make sure you're able to write it off, right? If you're one of those folks that have these RMDs that are required to come out of your accounts and you don't want to pay the taxes on it, you can classify those as charitable deductions. The IRS still allows you to take the RMD. They waive off the taxes because they're charitable deductions. For those folks that are looking at gifting money to family members, you want to make sure you stay under the gift tax exemption. Just remember, the person that's giving the gift is the one that's responsible for the tax, right? So I want to stop there. I'm going to talk a little bit about the Sharia investment process, and then we'll open it up for questions and answers. Just bear with me 1 second. Let me get this sharing off. Great, perfect. Right, so here at Cetera, again, we get access to all of the possible investments in the area. When we talk about Sharia investments, right, there are a couple of significant factors that we want to look at, right? They're the big knockouts, and those are the things that everyone knows about. We don't invest in entertainment or alcohol or tobacco and things like that, right? But below those big knockouts are the capital structure questions, right? And when we look at capital structure of companies, we look at their debt ratios, their accounts receivable ratios, and portions of their income, right, when determining if something meets the Sharia compliant. So when we worked with Russell to come up with these portfolios, we took the Sharia screeners and attached them to the S&P. The S&P 500, and I assume most people know what that is. And this screener eliminated approximately half of the S&P, right? And some of these companies are companies that people know, use regularly, and never thought there would be a problem, right? And what we did is we had Russell backtest this stuff to say, hey, if we're eliminating half of the S&P 500, are we still getting the same growth rate, right? And what we found out was it was really interesting that we saw growth increase over 10 years with these portfolios. The interesting thing behind it is, we were trying to figure out why, because we just eliminated half of the S&P, right? And we come to this conclusion, right? When you eliminate companies that are very debt heavy and companies that are not as, that don't have as much free cash flow as the others, they tend to stifle performance a bit, right? So we're able to get the best of the best in the indexes and comprise that in a portfolio and get it out there for our clients. So now, again, I wanted to leave quite a bit of time for question and answers. So we're at 7:32 my time, right, here in the East Coast. So we're going to open up for some questions and answers. I don't know, Zob, if you want to jump back in or you want me to handle it.
Awesome. Alrighty. Well, thank you guys for presenting. So the first question, it looks like, was from Marine. Can these links be shared? Yeah, we're going to be sending them post-webinar, inshallah. If no one beats the market consistently, does every deal... Hey, Mohammed Khan, can you please clarify that a bit, if you can?
So the question one is, if no one beats the market, why ever deal with managed funds?
Ever deal. Okay, thank you. Sorry, I was thrown off by the every.
Yeah, it's a pretty common question. And I will say that question is not accurate, right? We have plenty of funds that outperform the market. What people will do is say, "Hey, it didn't beat the market this year, or it didn't beat the market in the last 3 years," right? So it depends on how much time you're going to invest, right? One of the companies that we work with quite heavily, they tote around in all of their marketing, right, is that their funds historically outperform their benchmarks. And their benchmarks are the market. Now, the other thing that I tell folks, it's not only about beating the market, right? So when we're talking about being more tax efficient, right, we may grow at the same rate as the market, right? But if we get to keep more of the money that we just made, we beat the market, right? So it's not only about how much you grow, it's how much you keep, right? Keep in mind, folks, any investment, once you sell them, you have to settle up with the IRS, right? The less money we get to give to the IRS, we keep in our pockets, the better our real rate of return is, our after tax rate of return. And then for folks that have those questions, happy to show you comparisons with data, right? We can't argue the data, right? It is what it is. Happy to go through that with you.
So Masih has a question. Would love to hear about your halal options in place of traditional 520.
Yeah, so great. There is not currently a Sharia compliant 529 available in the industry. The closest option is an educational savings account that Saturna Capital runs. Saturna Capital, they run the Amana mutual funds, right? Demir and I have worked with them for quite some time. We know, the ownership group, the portfolio managing group over there as well. But they do have Sharia compliant ESAs, right? Now, I will say, the issue with trying to be as halal investment as possible in the United States is extremely difficult, right? Our finance system is just not built that way, right? So we do have to make some sacrifices if you want the Sharia compliance. And we can walk you through alternative ways to save for college. Unfortunately, you won't get the tax shelter. But again, if you prefer the Sharia compliance, right, we'll walk you through the process.
All right. Aftab asked, I may have misheard the RMD side of things. How does it work and how is it tax deductible?
Yeah, so RMDs are required minimum distributions. They exist when you turn 73. The IRS says, hey, if you're 73 years old, anything that you have in a retirement account that is not a Roth account, you have to take a minimum distribution. The other time they exist is when someone passes away and leaves an IRA or 401k to the next generation, right? So let's say, God forbid, or, my mom passed away and she left her IRAs to me. I would be required to take distributions from that. Now, those distributions, if they're traditional accounts, those are going to be taxable as income to you, right? But you can list all or a portion of that distribution as a qualified charitable distribution, and it becomes tax-free, right? It just has to go to a charity. So let's just say I wanted to donate some money to my local mosque, but I know I had to take this RMD. I can process that as a charitable distribution. The IRS is fine. I took money out of the account, right? It went to the mosque. I don't have to worry about paying taxes.
Awesome. Alrighty. So it looks like M. Khan had another few questions. Is contributing to an IRA really worth it? That's the first one. And what are lower risk instruments available for those who don't want Riba in their portfolio?
Yeah, so I do think contributing to an IRA is worth it, right? So when you're thinking about IRAs, right, there are two types. There are traditional IRAs and Roth IRAs. Traditional IRAs are pre-tax, Roth IRAs are post-tax, right? We like Roth IRAs a lot because, again, whatever that grows to, it's actually real money. You don't share with anyone. You take it out and spend it, do whatever you want. The IRS never bothers you. But a lot of folks will use a traditional IRA because they need some tax write-offs now, right? If you putting $7,000 into a traditional IRA moves you down a step in the tax code, it's a big benefit for you, right? The other thing is that those investments get to be tax sheltered while you're earning money in there, right? And to answer the other part of the question, for to avoid Riba on conservative accounts, right? There's a couple of things. You can get a money market fund that doesn't pay interest, right? Or you can use a sukuk fund. Sukuk funds are perfectly fine. They work like bonds. They're not guaranteed, but they're very conservative. And the interest income that comes off of a sukuk is completely compliant because you have an ownership stake in that company or country that you're purchasing it from. And we can go further deeper into that.
So Mohammed Khan also asked, can you share the data? I guess we could share that post webinar. Maybe we can even email you directly.
Yeah, I would reach out directly, and then we can show things that work very well. Again, and it is something that's relatively easy to Google as well. You can just say, hey, Google, or ask ChatGPT, what mutual funds outperform the S&P 500. But we're happy to provide the data. Just reach out to us independently, and we'll sit down and go through it with you.
Definitely check it out. It's on the website. So
Yeah,
going back,
it's making life easy.
Yeah. All right. So Sub asked, do you recommend a Roth 401k over a regular 401k, and why?
So that's a difficult question to ask without knowing your income and assets, right? If you're a higher earner, so I'll give you an example. I met with two of my clients earlier this week. They're surgeons here in New York. They make 800,000 combined, right? When you make that type of money, or when you go over 500 grand, you lose almost 40% of your income in taxes, right? So they use their traditional to save some of that money that would have been lost.
Mm-hmm.
We don't discriminate against the Roth IRA. They use them as well, and we love to use them, right? But we want to try to help find a healthy balance to say we want some tax write-offs now, right? And we want some tax-free income in the future. The other thing to consider is most companies will only match the traditional option, right? So you may have a Roth 401k, you're still going to have to open up a traditional one, because if you want the company match, it's only going to go in there.
Mm-hmm. Mm-hmm. So Noreen asked, if all of this is new to us, from investing to a 401k, contribution best practices, etc., how can we learn all the basics, how to approach this? Well, I'm going to just shout out really quick. This is kind of why companies like Cetera exist, Nama exists, and all these other companies exist. It's because if you're a novice and you're making money that you have disposable income, you should definitely talk to someone that can manage your money, because even managing money, it's kind of like going to the doctors, right? Like the doctor does an audit of your body, essentially, right? They're making sure, hey, look, we got the blood work done, your A1C is this and that and whatever, and then they can make suggestions. That's kind of like what a money manager does. And I guess Sharaz and Demir, you guys can, touch on that a little bit more.
Yeah, when we were setting up this workshop, I was speaking to Hannah about this, right? There's a lot of misconceptions out there about what it costs to work with an advisor, right? Now, some advisors do have minimums on how much money you have to invest with them. We don't have those minimums, right? So we can take money from, we can invest any amount of assets. The reason why we don't have those minimums is when we look at the population that has most of the wealth, that's typically the baby boomers, right? And the baby boomers want to make sure that their wealth goes to the next in line. So a lot of our younger clients come from our older clients, right? They're fresh out of college or may have their first job and they're not making much. That doesn't mean that they don't deserve some help, right? So we have programs set up where, hey, if you're right out of college or this is your first job and you're trying to get your financial life in order, we have programs that will help you up. We'll provide the education for you. For my friends that are in the South, Dave Ramsey's really big in the South. I am one of the Ramsey pros up here in the Northeast as well. So a lot of those things, a lot of those resources could be beneficial. I will say with the Sharia compliant stuff, it is very hard to find an advisor that's, competent in that space. And the reason because the space is so small. Right? When you think about the size of the Muslim population in the US, we're a tiny number. When you think about the amount of assets that are in the US, you're looking at, companies that manage $7 trillion, $10 trillion, $15 trillion. Right? The Sharia compliant firms, they don't really manage that much cash because they're much smaller. It's a much more niche market. So what you would do if if you don't want to reach out to us, you want to find someone else, you have to do your due diligence and say, hey, if I'm going to go interact with an advisor and I want these services, if that advisor can't provide them, right, go find someone else, right? Yeah.
It's like a real estate agent. If they're just
It's
not
any
cutting it,
professional, right?
everything, yeah.
Yeah, literally every professional.
Mm-hmm. Yep. So we got Fatma who asked the question, what types of investments are suitable for 1099 contractors to reduce their taxable income?
Yeah, so a couple of things that you can look at from a 1099 standpoint. If you're looking at the retirement side of it, you can use any IRA from a traditional or Roth. You can use a SEP IRA as well. Or if you are a higher earning 1099 employee, solo 401ks are really cool as well, right? They allow you to put a lot of money away, and you do save quite a bit on taxes. So we definitely can help out with that. We definitely can, when I say IRA, K, things like that, those are tax codes, right? Those are account registrations. Those are not investments. Investments are the things that go inside those plans, right? So you can have a 401k and then add your Sharia compliant stuff to it, right? You can have a SEP IRA and add your Sharia compliant stuff there as well, right? So the options are pretty plentiful depending on, the amount of assets you have.
Can you, and this is a follow-up question to that. So you can take your RSUs that have been vested, they're ready to go, and you can put that in one of these plans?
Yeah, so it depends on where you got your RSUs and how and what the restrictions are. So let's say, you have non-qualified RSUs, they're not going to go into a qualified, right? But the thing that you have to remember with your RSUs, when you exercise, that's a taxable event,
Mm-hmm.
right? And you want to make sure when you exercise, you don't pay the alternative minimum tax on that,
Mm-hmm.
right? Or you're not going to pay net investment income tax on it,
Yep.
right?
So that's the same case as an exercise sale. So for example, if someone, you sell your shares, let's say a company gets acquired and they're, doing a cash acquisition and they buy out everyone's equity. Let's say there's a bunch of employees that haven't exercised. Would they pay taxes on the exercise and also the sale as well?
Yeah, so with mergers, right? What you're describing is acquisition, right? So acquisitions are a little bit different than RSUs,
Mm-hmm.
right? So once you actually exercise the RSU, because the RSU is essentially an option, right? An option to buy, right? And if you don't buy it and it expires, it goes away, right? For the most part. If a company is acquiring you and you exercise that security, right, for the purchase, it is a taxable event.
Mm-hmm.
Yeah, it's going to be taxable. We can't get away from the IRS,
Yeah.
right? Now, if you have company stock and you're part of a merger or an acquisition, and this happens a lot in the startup space, right? A lot of times you will have a restriction period put on you, right? So I have a really nice client. He was a senior exec at Smarsh. I think a lot of folks in the tech space know Smarsh, right? Smarsh is still private. When they IPO or if someone acquires them, anyone that has, stock there, they're going to be put on a 6-month waiting list before they can sell, right? And
Mm-hmm.
that's typically what happens with these mergers, right? Because they just don't want to flood the market and distort prices.
Mm-hmm. Mm-hmm. Yeah. So that's actually a scenario that happened with Slack. The Slack employees were put on a 6-month period.
Mm-hmm.
The sale price of the stock, or well, when they IPO'd, actually, The IPO, pre-IPO price was around $60. And then what happened was in that 6-month period, the stock went down to like $7 or something like that when people were allowed to sell. So then people were in a sense losing money at that point because their strike price was actually higher than the $7.
Yeah.
So
So there's a way around it, right? So Mark Cuban has become very famous for that deal, that same scenario of what you're talking about. When he sold his company to Yahoo, right? He sold his company for billions of dollars to Yahoo. And he's very public about this, right? You can Google this, YouTube it.
yeah, I saw it on Theo Vaughn's podcast the other day.
Yeah,
he was talking about it.
It's probably, he says it's the best trade he's ever made in his life, right? Because he was put on that 6-month pause, right? And what he did is he bought an option strategy around his position, right? We all know what happened to Yahoo, right? He protected his position, right? So his gain was locked in with his option strategy. And he just had to wait for the 6 months to go away, right? Close out his option strategy, sell his shares, and he was able to keep his gains intact, right? So, we will see a lot of folks do things like that if they're part of pretty significant IPOs. So like the Slack folks should have done that, right? It's just, I would say a lot of times people get kind of caught up with the IPO and, kind of like the ego gets involved and they're like, no, we're good. This company's going to do great forever, right? And then it doesn't, right? And then, left holding the bag. It's like the opposite of NVIDIA, right?
Yeah. Yep, that's the exact fear that I have personally. Like a lot of my compensation is banked on options and equity. So that's like the biggest fear that I have. And, every day I contemplate, I'm like, hey, look, are they going to sell? Are they, is this guy going to hold? Like, will the market be sharp, for us when we do sell, or will it actually be on a decline? Like, that's kind of like the biggest fear and anxiety, and a lot of people actually don't know this stuff. That's why it's always good to be getting advice or mashwara, right, from someone who's actually knowledgeable in this, because it could be a matter of hundreds of thousands of dollars, millions of dollars, and for in some cases billions, right, like Mark Cuban's case. So he became a billionaire because of that one tactic. The product tanked about a
Yeah.
year or two later. So.
Yeah, Yahoo took a big drawdown within that 6 months. And this is one other cool thing about working with Cetera. Because our company's so large, when people have very, very unique situations, right, we have access to our advanced planning team. And so this is a team of attorneys, accountants, and advisors do money management. They assist with these types of events, right? Whether it be like, an estate settlement type of event or a large exit from a founder or a angel investor. We have access to those folks. So, if something is really unique, we can bring in our advanced planning team and our lawyers will work with your lawyers just to make sure everyone's on the same page and everyone's speaking the same language, right? And that's something pretty unique to Cetera. We have a lot of cool resources that are available for those types of scenarios. So hope one of those startups go big, and then we'll be having a different conversation.
Yeah, inshallah. Yeah, we should definitely talk post call. Well, I want to thank everyone for hopping on today. We will have this recording emailed to everyone within the next day or so. So probably by Friday evening. This will be posted in the Future MP Academy, which is pre-announced. Like, I haven't officially announced it, but we will be having an academy for Muslims to learn from other Muslims for free. So that's going to be something super exciting, and we will be uploading this on our podcast as well. So if you're going for a run or whatever and you want to learn about tax savings and all that stuff, this will be the recording to listen to. Sharaz, Demir, thank you so much for hopping on. Is there a way people can contact you guys?
Yeah, so a couple of things, right? We plan on doing more of these with the Muslim professional teams. I think we're going to do 3 next year. And we want the community to tell us what they want to learn about, right? So what we're going to do is we're going to work with the admin team to create some types of surveys to get feedback. And we'll work with you guys to send them out and send it out to the entire community. And what we'll do is I'll just ask what people want to learn about, and we'll start curtailing our presentations to that so you can get the most out of it. But yeah, we will have our info posted up, and I think we'll get you guys to send that out as well.
Yep. I'll send out the info, and then yeah, we'll definitely send out a survey. So Sharaz, Demir, let's get cranking on that, and I'll send that out in the next coming days. Let's actually shoot for post Thanksgiving, because everyone's gonna actually be awake after Thanksgiving.
Yeah.
I feel like people are already starting to check out for the next 2 weeks, but for sure our biggest problem, I think, in the Muslim community is financial literacy. And Shadi was on the chat today, and he's done sessions on this. Definitely the biggest lapse we see is financial literacy in this group. People have successful businesses, they're really great at selling product or moving up within a company, but then what the heck are they doing with their disposable income? That's one. And then two, how are they saving as much money as possible from going out to the hands of the government? We already know our money is appropriated. So how do we not give as much? Because we don't actually need to, and we don't realize that. So let's learn as much as possible.
Zobin, you and I spoke about this on the podcast before, right? And generally in our community, it's kind of like a taboo topic, right? To share your finances with them. It is not a taboo topic to seek for help, right? Right. If you know that you need help with something, look for a professional. Do not go to a resource that has no experience, right? Seek out a professional. Again, we have access to every bit of technology out there. If you're looking for someone to work with, you can find someone to work with, right? Definitely not a taboo topic. So, yep, looking forward to working with you guys as well.
All righty, guys. Well, assalamu alaikum. Have a great night, everyone. Enjoy your dinners. And if you're in the West Coast, thanks for hopping on, during work hours. Assalamu alaikum, everyone. And we will be sending this recording out soon, so just be on the lookout.
All right. Assalamu alaikum, everybody. Have a great day.
Assalamu alaikum, everyone. Have a good night. Thank you.